Welcome back to the deep dive. Today we're really getting into Sirca Paints India Ltd, or SBL. They're a big name in India's premium wood coatings market.
Yeah, a major player.
Mhm.
And we've got their latest numbers, the unaudited Q2 results for fiscal 26.
Right. And not just the numbers. We also have some key strategic updates from their recent filings. Things like board meeting outcomes, press releases.
And their investor presentation.
Yeah.
So our mission today is basically to pull out the main story here. What's the snapshot look like?
Exactly. We want to understand, how they actually did financially between July and September 2025.
The short-term picture.
And then connect that to the bigger strategic stuff they're putting in place for the future. Things like market reach, new manufacturing plans.
And especially that big news about securing their technology pipeline from Italy. That's crucial.
Definitely. So just to quickly set the scene for you, SBL isn't your average paint company. They focus on high-end wood coating.
Yeah, think premium finishes. Brands like Sirca, Unico, and they also acquired Wembley recently.
And the key thing is that exclusive license they hold for Sirca from Italy.
Right, they're the sole licensee in India. That basically positions them as the main channel for these, really specialized, high-quality Italian wood finishes.
In a market, India's furniture market that's growing incredibly fast.
Absolutely. Okay, so let's dive into the financials then. Q2 fiscal 26.
Okay, let's unpack this. Management used the phrase resilient growth accompanied by higher earnings. Let's see if the numbers hold up.
Well, on the growth front, definitely. Revenue from operations hit INR 131.17 crore in the quarter.
Okay, 131 crore. How does that compare?
That's up 24.37% compared to the same quarter last year, Q2 FY25, when it was about 105.5 crore. So yeah, solid growth.
24% top-line growth is pretty good, especially if they faced market challenges, which they mentioned.
Right, but here's where it gets, even more interesting. The profit growth.
The bottom line. How did that look?
Much stronger growth there. Profit after tax, or PAT, came in at INR 18.0 crore. That's a jump of 36.30% compared to last year's 13.28 crore. So profit grew significantly faster than revenue.
Wow, 36% PAT growth versus 24% revenue growth. That's a big difference. What about PBT?
Profit before tax, similar story, up 36.17%. Really strong leverage there.
And that translates down to the shareholders too, right? Earnings per share.
Yep. EPS increased to INR 3.24 for the quarter. That's a 33.88% growth year over year. Healthy increase.
Okay, so the numbers clearly show higher earnings, but how did they manage that? How did profit grow so much faster than sales?
Right. That's the key question. And the answer seems to lie in their operational performance, specifically EBITDA.
Earnings before interest, tax, depreciation, and amortization. What did that do?
EBITDA rose to INR 27.40 crore. Now compare that to last year's 18.96 crore.
Wait, let me do the math.
That's
okay. 44.52% growth.
Exactly. 44.5% growth in operational profit. That's massive compared to the 24% revenue growth.
Okay, so that's the operational story. Why such a huge gap? What drove that efficiency?
Well, it points to a couple of things. Primarily, as their press release mentioned, an improved product mix.
Meaning they sold more of their expensive stuff.
Precisely. They increased their focus on high-value product segments. These naturally carry higher margins. So even if volume growth wasn't spectacular, the value of what they sold increased significantly.
So less standard paint, more premium, specialized coatings, perhaps?
That's the likely driver. Combine that improved mix with what they call disciplined cost management, and you get that margin expansion.
The margins. Let's talk about that.
The EBITDA margin improved quite a bit. It hit 20.89% in Q2 FY26.
Okay, almost 21%. What was it before?
It was 17.98% in Q2 FY25. So that's a jump of nearly 3 percentage points.
That's significant margin improvement in 1 year. Shows the strategy is working, right? Selling higher value products is paying off.
Definitely. It really highlights that focus on premiumization and operational efficiency.
And this happened despite those market challenges they mentioned. What were those exactly?
Yeah, the management commentary did flag a couple of headwinds during the quarter.
What kind of things?
They pointed to extended monsoons, which, tend to delay construction, renovation projects, that sort of thing.
Okay, that makes sense. Anything else?
And also an early festive season. Apparently, the timing this year temporarily affected retail demand patterns and maybe some project timelines too.
Extended monsoons and an early festival season. Are those just standard excuses, or was it genuinely tougher than usual?
It's hard to say precisely without being on the ground, but the commentary suggests the combination was impactful. It likely disrupted the usual flow for both retail and project work.
But the key takeaway isn't that things were tough.
Exactly. The key
Yeah.
takeaway is that they still managed nearly 45% growth in operational profit despite those frictions. They used internal levers, product mix, cost control to power through.
Okay, so what about looking forward? What's the demand outlook? Are things picking up?
Management sounded cautiously optimistic. They mentioned seeing encouraging green shoots of demand recovery,
Where specifically?
particularly across urban markets, it seems, and also in the organized manufacturing sector.
Ah, the OEMs.
Right. And there's a bigger tailwind here, too. India's whole furniture manufacturing sector is expected to expand quite robustly,
Why is that?
driven by rising domestic consumption, obviously, but also this global trend of companies looking to outsource manufacturing to India.
Okay, so more furniture being made in India means more demand for wood coatings,
Mhm.
especially premium ones if it's for export or higher-end domestic markets.
Precisely. That provides a sort of structural underpinning for demand for companies like SPLL.
Got it. So strong Q2 performance driven by margins and product mix, despite some headwinds, and a decent demand outlook.
Yeah. And if we connect this to the bigger picture, these results aren't just happening in isolation. They're supported by some really deliberate long-term strategic moves.
Okay, let's shift gears to that strategy. What are the foundations they're laying?
I think the first and maybe most critical one is locking down their technology source, that Italian partnership.
Right, the Circa SPA Italy deal. What's the latest there?
They extended the agreement, and not just by a few years. They extended it all the way out to 2041.
Wow, 2041. That's nearly 2 decades from now. That's incredible long-term security, isn't it?
It really is.
Yeah.
It essentially guarantees them continued access to the technical know-how from Circa Italy. We're talking about high-quality acrylics, UV coatings, polyester-based systems, the cutting-edge stuff.
And this allows them to manufacture these locally in India.
Yes, that's the key. Transfer of technology for local manufacturing. It secures their premium product pipeline for a very long time.
What does a deal like that signal to the market, to competitors, and what does it cost them? It must be expensive, right?
Well, it signals immense stability and confidence, obviously. For competitors, it means SPLL's access to top-tier tech is locked in, making it harder to compete on that high-end R&D front.
And the cost.
Surprisingly disciplined, actually. The agreement specifies a quarterly royalty payment of just 0.75% of turnover.
0.75%. For a 20-year technology license, that seems quite low.
It's generally considered very favorable. It's not a huge drag on their P&L, but it ensures they stay at the forefront technologically. It's a really solid foundation.
Okay, so technology secured long-term. What's the next strategic pillar?
Operational integration and efficiency, specifically relating to the Wembley brand they acquired.
Ah, yes, Wembley. Acquired back in March 2025, right? An old brand, established 1961.
That's the one. So Wembley came with 3 existing separate manufacturing units, likely older facilities.
Okay.
What Subagawa is doing now is consolidating those 3 units into a single new integrated production facility.
Makes sense. Get rid of the complexity, the duplication.
Exactly. It's all about achieving economies of scale, streamlining the supply chain, standardizing quality control, optimizing cost structures, reducing overheads, all the good stuff that comes from consolidation.
Classic efficiency play. What's the timeline for this new facility?
They said it's currently under conditioning. The target is for it to be fully operational by Q4 of this fiscal year, so by early 2026.
Okay, so that investment should start feeding into potentially even better margins down the line.
That's the plan. It directly supports that operational efficiency story we saw in the Q2 numbers,
Yeah,
making it sustainable.
right. Technology, manufacturing capacity. What about the products themselves? Any innovation focus?
Yes, definitely. Their R&D seems heavily focused on areas with high future potential. Specifically, they mentioned acrylic-based systems and, very importantly, waterborne PU systems,
Waterborne polyurethane. Why is that significant?
because that's where the global market is heading. Sustainability, lower VOCs, volatile organic compounds, environmental regulations. Waterborne systems are seen as the future for high-performance, eco-friendlier coatings.
So they're investing in R&D where the puck is going, not just where it is now.
Pretty much. It's about innovation, performance, and sustainability.
Oh, right.
And they actually launched something new this quarter, too.
Oh, yeah.
A new range of premium PU coatings launched under the recently acquired Wembley brand, but specifically through a new sub-brand called Valentino,
Valentino under Wembley, targeting what segment?
targeting the premium furniture segment. So again, reinforcing that focus on high-value niches.
Okay, interesting. Let's switch focus slightly to their market position. How do their sales break down?
It's quite weighted towards industrial clients. The figures show 70% of their revenue comes from OEM's original equipment manufacturers.
70%. So big companies like Godrej, Jindal Stainless, those types of
Yeah,
clients.
exactly. Major manufacturers who need consistent, high-quality coatings in volume.
And the remaining 30%.
That comes from the retail channel.
Okay.
So they still have a presence there, reaching smaller contractors, consumers perhaps. It's a dual approach.
And geographically, are they expanding?
They mentioned focusing on expanding their reach, particularly in Western and Southern India.
Makes sense. And they're also trying to build brand awareness with the people who actually specify the products, right? Architects, designers.
Absolutely. That's crucial in the premium segment. They mentioned activities like participating in ARth Dubai, which is a big design event.
Getting the brand in front of the key influencers.
Right. And they've also enhanced their digital tool for professionals, the Sirca Paints Pro app.
Ah, the app for contractors and dealers.
Yeah, apparently they have over 25,000 registered contractors on it now. It's a way to build loyalty, share technical info, run schemes, keep that B2B network engaged.
Smart. Okay, one last piece. The capital structure. They needed money for this Wembley consolidation and expansion, right?
They did. The notes to the results mention some financial activity during the quarter, specifically a preferential share issue.
How much did they raise?
They allotted just under 20 lakh equity shares, 19.84 lakh shares, to be precise.
Okay. At what price?
The issue price was INR 379.185 per share.
So doing the math, 19.84 lakh shares at roughly 380 rupees each, that aggregates to about INR 75.29 crores.
Correct. Around 75 crore raised. And as you said, that's earmarked for expansion, investment, funding things like that new consolidated facility.
Now, for you listening, how should one interpret that preferential allotment price of 379.50? Does it look like a good sign?
Well, generally, when a company raises capital like this, especially through a preferential issue to specific investors, it suggests management feels they have good projects to invest in that will generate strong returns.
Confidence in their growth plans.
Exactly. The price itself, 379.50, sets a benchmark for that new capital. Given their growth trajectory, the margin improvements, and these strategic investments, it's likely seen internally as a fair valuation to support the next phase of growth.
Even though it means some dilution for existing shareholders in the short term.
Yes, that's always the trade-off with raising equity. But the bet is that the investments will create more value long-term, offsetting the dilution.
Okay, so let's try and wrap this all up. What's the core narrative from this deep dive into Spial's Q2 and strategy?
I think the main story is strong execution meeting smart strategy. Q2 showed really impressive operational efficiency, getting that profit growth way ahead of revenue growth by focusing on high-value products. That's the execution part.
Right, managing the present very effectively.
And then strategically, they're locking things down for the future. Securing that crucial Italian technology link all the way to 2041 is huge. And consolidating manufacturing with the Wembley integration sets them up for sustained efficiency and scale.
So building capacity and margins simultaneously, covering both the short-term performance and the long-term foundations.
Precisely. It looks like a company firing on, well, several cylinders right now.
Okay, a clear picture then. But let's leave you, our listener, with a final thought to chew on.
Go ahead.
We talked about their strategic R&D focus on waterborne PU systems. That aligns perfectly with global trends towards sustainability, right? Lower VOCs, cleaner products.
Definitely. That's the direction the industry is moving, globally at least.
But the Indian market still has a massive installed base of traditional solvent-based coatings. So the question is, how quickly will that shift happen in India? Will it be driven by regulation or consumer demand or both?
And following on from that,
And if Spilio really does maintain this early aggressive focus and R&D lead in waterborne technology, while maybe some domestic competitors lag behind, what kind of competitive advantage, what kind of moat are they actually building for themselves in the long run? How big could that advantage become?
That's a really interesting question. How sticky will that technological lead be in the specific context of the Indian market's transition speed? Something to definitely think about.